Hello, this is Sunny Agrawal, a student of BITS-pilani campus, presenting the final pitch report of Wipro for Equity Research Initiative. Disclaimer: the analysis and the calculated values are my own and have no bearing or responsibility if they are wrong and misrepresent Wipro. The IT industry has sustained its growth trajectory in spite of the tough economic conditions in India in 2012. The primary reason behind this is the adaptive strategies employed by the major players of the industry, Wipro, TCS and Infosys. With the economic conditions improving and as the IT industry contributes a fair share to the GDP, it is a hot sector to invest in. Wipro, which had diversified into the IT sector, has now made it into its primary source of income. The major revenue is generated by the outsourcing of services to the US, where the economy is showing positive signs for the industry, and with the high rupee versus dollar rate, Wipro's revenue generation will surely grow at a swift pace. For 2012, Wipro's returns on assets and equities stand out at 21.24% and 19.24% respectively, both high compared to the industry average returns. Also, the PE ratio of the company stands at paying Rs 16 for every rupee of earning, which is also a standout amongst its peers and the industry. The company is also very well leveraged with high interest coverage ratio and low debt to equity ratio, which is a feature which is common to the industry as a whole. Wipro has been paying dividends for the last 20 years, so both the dividend discount models and the FCFE models were used to value the stock, with the growth rate being estimated by both the PRAT model and the return on equity dividend payout ratio method. The two-stage DDM FCFE models show that the stock is overvalued in the market, suggesting the holder of the stock to sell it. The constant growth DDM model shows that the stock is nearly valued, but that was calculated at a very high growth rate of about 17.2%, which can be safely kept aside as no company can be assumed to grow at 17.2% for perpetuity. However, if the performance of Wipro is to be analyzed over the years, we can nearly see every profitability ratio to be on a constantly declining trend. The primary reason for the same is that the net sales are increasing but with falling net income. This means that the earning potential of Wipro has decreased with the increasing cost of sales, or per dollar earning of Wipro has decreased. Also, peer analysis shows that both Infosys and TCS are faring better than Wipro in terms of return on equity. But this higher return comes with greater cost of investment. Price per share of TCS and Infosys is very high as compared to Wipro. So finally, I conclude that for Wipro should be short sold and bought back as the prices are expected to fall down, then held for short term as the stock is expected to give average returns, and then reinvesting the earnings in TCS or Infosys provided that their valuations are not stretched in order to get better returns, as the industry is shown to be hot in 2013. Thank you.